Hey guys, Patrick, Donovan, eXp Realty, part of the Johns Group here with Brandon Giebler from Next Move Realty. What's up, buddy? How you doing?
I'm doing fantastic. How are you doing?
I'm doing good. I'm ready to talk about this 50-year mortgage thing. Are you excited about this? You've been studying all day on this one, haven't you?
I've been watching a lot of videos and trying to figure out how this makes sense, and I'm glad Lucy's here to help it maybe make sense to. But we'll find out.
We'll see. Maybe she's got the pros. We definitely have some of the cons. So we're going to be going over it today. But today we're talking about 50-year mortgage. Is it good? Is it bad? Is it dumb? Is it not? Who knows? Who doesn't know? We're about to find out. Lucy knows, I'm sure. And then we'll be joined by Lucy Thornton, Lucy the lender from Edge Home Finance. She's going to be answering some of our questions. If you have questions for Lucy, please comment down below for everyone to see. And so, Brandon, are you ready to do this?
I'm ready. I'm ready. Put me in coach. I'm ready. All right. So we're gonna start with. I want to preface this whole thing like we've done the research. We've looked into all these things. We've heard all the views. So this is what has been compiled. So yeah, we may agree with some, maybe not all, but we're figuring it out with you guys at the same time. So I just want to preface that.
Well, the internet, we did some internet research, asked them questions on what it believes, and there's some stuff we just don't agree with in here. So we want to make that up front.
Yes, but this is a lot of the common popular trends kind of things that have been asked and looked up and all that stuff. So the truth about the 50-year mortgage, how it works, who it helps, why it might solve the affordability crisis facing American homebuyers today. So let's dive into it. If you're confused too, type 50-year question mark in the comments, you know?
If you're here, thank you for watching. I really appreciate comments so I know who you are. If you're here, like and share with your friends that might not know what a 50-year mortgage is. The good thing is we got a professional lender on here to explain it all to us. So even if me and Brandon sound dumb, which I doubt that's the case, but if we do, we got a lender on here to straighten us out. So talking about this 50-year mortgage, what does it actually do? Well, I mean, it'll lower your monthly payments by about 5 to 6%. If you look up on the internet, you might see 10 to 11%. There's some methodology here, and Lucy's going to be able to tell us if we're right or wrong. But we have to make some assumptions going from a 30 to a 50 that the interest rate's going to be higher on the 50 because of the risk. So that's why we say 5 to 6% difference in your payment monthly. Another thing the 50-year mortgage does, it gives you a massive interest burden. In some cases, it's nearly double the interest that you would pay on a 30. Your timeline is pretty unrealistic. I couldn't believe this, and this was shocking to me, right? The average age or the median home buyer age is 59 years old. 59 years old. So if you got a 50-year mortgage of 59, you'll be paying into your 109s. The barista at Starbucks at 100 years old. Hey, okay, I think that's hello, y'all, right? Hey, hello, y'all. Thank you for joining. I really appreciate it. Thank you so much. And then, of course, a false affordability. I mean, it doesn't really solve the root of the problem of affordability. It just stretches your payments out along 20 more years. So.
Oh my God. So I think this one is labeled perfectly. The perfect storm. I feel it really is. It's like the movie, The Perfect Storm. The home prices remain at these record high levels, and the interest rates, they just stay elevated. And that's just the time that we're in right now. So the policymakers and the lenders are searching for creative affordability solutions.
I love it when they use that word too.
It's one of those how do I make it sound nice and sweet and better than it actually is. I'm creative too, and all my creative things are still in the closet because they're not good or done yet, but it's fine. But here's the catch. So extending the loan term is politically and financially easier than the real solution. So I feel lowering the interest rates or reducing the home prices. Which I feel like we now are finally coming into that time that prices are starting to be more realistic and not reaching for the stars kind of thing. So I feel like this is actually going to move us backwards.
I totally agree with you. I think that exactly what you're saying. Like, I feel like it's finally starting to, the system's starting to work,
right?
But not fast enough for these people in office, which I don't care about. And okay, or hello, y'all says, so your kids will harbor your debt. Think so wait till we get to some of these sites. You're gonna be like, whoa.
So they have to clean out your house, figure out what to do with your stuff, and then pay your debts.
Yeah, that's good stuff.
Bravo.
All right. The numbers. All right, so 30-year to 50-year, and here's the difference. Okay, so I just want to show you this really quick to show you where we got these numbers from. We talk about $400,000 home with 20% down, so you're financing $320,000 at 6.1% interest rate. I just want to show you where we got it from. So 6.1% interest rate was during our research. That's kind of the number they used. Their numbers didn't make sense to us, so we plugged it in this calculator to make sure that we knew exactly what we were talking about. In this calculator, we took out the insurance, the taxes, the HOA fees, because we just want to make it as even as possible, not to have any of that in there. Okay, so this is where we got our numbers from. So if you're curious, and also if you want to curious about the interest rates, and Lucy can talk about this more, but today, here's the interest rates we're looking at as according to Mortgage News Daily, okay? Every person has their own credit score. Every person has their own interest rate. So that's why you got to talk to Lucy. But these are where we get our guiding numbers from, okay? Now, going back to our slide. All right, so a 30-year mortgage, monthly payment is going to be $1,939. Total interest paid, $378,106. Debt-free by retirement for most buyers. Unless you're buying at 59, then you will be most likely dead. 50-year mortgage, your monthly payment is $1,828. Total interest paid is $776,822 with a monthly savings, and I say savings loosely because really you're going to be paying it. It's just stretching your payment out. You're saving $111.15. Now, here's the thing: to save that $111 a month, you're going to be paying an extra $400,000 in interest. Okay, now the assumption I made, and this you can read this at the bottom. Okay, I'm assuming that if you go from a 15 to a 30, that's about 50 basis points right here, as you can see here. So we kind of just said, hey, if you're going from 30 to 50, probably another 50 basis points. So that's the assumption. Of course, once again, Lucy will be able to dispel that or whatever. Okay,
it was a really good educated guess.
Educated guess.
It was really educated guess. So this is going to be your longer mortgage, cheaper, most definitely myth. I'm calling it the ring of fire because this is just, I feel like this is what it kind of leads into, which longer term. Okay, so you get more buyers technically that can afford the monthly payment on expensive houses. So you got people that couldn't afford $1 million house that can all of a sudden afford $1 million house. They're like, oh, you and you and you and you and you. So I'm going to raise it to $2 million. Good job. So we're just going to increase the competition. So there's going to be more buyers entering the market chasing this, in some areas, limited housing stock. We've got plenty down here. So if you can't find a house, like we got you down here.
Give me a call. Got you.
If you're up north, then sorry you live up north. But it's just going to raise the prices. And and then back to square one, which is we're finally in this time where we're actually, the market's soothing. It's like, I just feel like this is a disaster, and I don't think that it's going to be something great. And if you agree, comment disaster. Because this is,
well, I would say the one thing is, and I think everybody that you've been watching today probably agrees with you that it's probably a bad idea, right? Because you're going to increase if for instance they do it, right? Just think about a scenario. and it's not really saving that much. So I don't think that it's going to actually do anything personally here in this area. But if they did do it and then people came to the market and raced to the market, right, then it's just going to push the prices up to past the affordability again. So we're back to, like you said, Brandon, circle of fire.
Right. It's awful. We're finally getting to the point where people are realizing the actual value. And now we're like, let's offer this because you can and buy a house. Like,
well, hello, y'all said this is a pig painted pretty to gain political favor to folks who aren't or will never be educated on these things. Disaster. I agree. Disaster.
I mean, you can be educated if you follow along and watch the videos. So shame on you if you don't watch.
If you're not educated, it's your fault, not ours. We're trying to educate you. I'm just saying. Yeah. But who is really benefiting from this, right? And once again, this is one of those things that we don't agree with all of it. They're saying that the builders are going to benefit from this. Either way, they're saying that the home buyers are not going to benefit from this, but the people that could benefit from this would be the builders, sell more inventory. Now, here in the Savannah area, there's tons of new construction inventory. So, and they're giving out 3.99% interest rates. So that didn't help. Now I heard they're giving out a 1.99 to 2.99 to 3.99 3-to-1 buy down. So that's crazy. So builders are not going to get helped by this, but you know who is going to get rich from this? Banks, lenders, institutional investors. This will help their cash flow a little bit. Larger buyers trying to collect all these homes. Now, I don't know if there's a bunch of first-time home buyer homes left anymore. I think the large institutional buyers own all of them right now. So are they going to benefit? I don't know who this really benefits, to be honest.
It benefits BlackRock, who owns the majority of the housings in the whole market. It benefits American Homes for Rent, who owns a quarter of the houses in this big old neighborhood I live in. It just
our neighborhood too, about 0.25% of our houses.
It's unreal. It's just going to help the people who already don't need help. So, I mean, A1, it's a great suggestion by someone who should know more about housing. so
Hello, y'all says this is meant to gain money for corporations, not individual buyers. I agree.
100%. So it's making more and more sense every time I read it. So this is us trying to make it work. How does the 50-year mortgage work potentially? So you're going to save your $111 every month. But the thing is what you do with that $111 a month, you have to be consistent. You got to be on point. You can't miss it. You got to invest it into something with some sort of return for you in the future. But you can't touch it. So if you cut off your fingers or if you need a surgery, if you need a life-saving thing, like, don't touch it, or you lost
all the benefit of it, right?
It's over. So unless you get the Tesla phone that complies with the Tesla chip that you can robotically remember to make sure that you're investing that exact amount into this exact account at this exact time every month, then what's the benefit here? I think long-term investors, I can see how this can benefit a little bit, but that again is a stretch, and we're still leaning more towards the BlackRocks and the American Homes for Rent and the Black Pebbles and all their little surnames or whatever they have. It's just, I don't even know what it's not going to work. My opinion. Sorry. It's not going to work.
Why the 30-year mortgage still wins? All right, there's an actual finish line. After 30 years, you can actually be done paying for your home, and then you can retire. Think about it. If you bought your home at first-time home buyer's age right now, unfortunately, is 40 years old. Crazy. So they can retire at 70 years old. which is not actually that bad. You won't have a payment anymore. You know what I'm saying? Boom, retire. Not to mention the psychology of freedom. I mean, Brandon was talking about earlier, but I agree. Like when I paid my car off, it was like, whoa, what a huge like day that was. Like I felt like celebrating and stuff, like partying it like it's 1999.
Right. It's like being able to unbutton that top button of your pants when you ate that big old Thanksgiving meal.
Just breathe. Thank God.
I can breathe a little bit.
The real life resilience. I mean, you know, think about it. Like life happens, right? You're saving all this money. You're trying to be disciplined, but then bang, you chop your fingers off on a saw or something like that, which is crazy. That would never happen. But I mean, just if it did happen, you would have them, you know, you have to worry about that. And then the market, the market reality, the math advantage just kind of disappears once the inflation goes up. So, I mean, it's really not really doing you anything. Oh, Josh thought it was funny.
Of course he did. Of course he did. Oh my God. Okay, so this is the part where it was kind of like I really had to preface at the beginning, but the real problem was labeled as supply. So if we can increase the supply to meet the demands, we've got so much supply down here that we've got listings that are getting a showing a month, like, but houses are still selling. So it's not a demand issue, obviously. It's most definitely the affordability side of it. And then the reforming the zoning laws to allow denser, more diverse housing developments. You think that adding more apartment complexes or something is going to help people become homeowners? We're going to take up all of the rural area and we're going to put in apartment complexes, so then there's no
Well, once again, I don't think that has to do with us. We're wide open down here. You're building all over the damn place, right? And they're talking about New York and those places that are a little tighter. Yeah, tighter building restrictions.
I thought this one was kind of cool though. The let the homeowners carry their rates to their new property, but that's not going to benefit the person lending the money. So that will never happen. But that would be cool though. Like you jumped in when it was hot, and they respected the fact that you bought a house or something, some kind of reward for buying a house and helping the community.
Can you get to keep your interest rate forever? Yeah, I don't think that's ever going to happen.
It's never going to happen. But it would be a nice gesture. You know what I mean? And then they have the credit reform, which is using your rental history to qualify for mortgages, which I think there's already an app for that. That you make your payments on time. It goes to your credit that you've made payments on time, so it shows that you're a reliable person who pays your stuff on time. So I think that's already happening, but I don't think everybody has it. But some places do. So if you're renting, you should probably ask about that if you want to buy in the future. And then the tax policy updates, like raising the capital gains exclusion threshold. I mean, how did you buy the house for like $100 and now you're going to sell it for $1 million? Like, it's not, that's, I would throw that one away, but apparently that's a thing. And then the limited institutional buying is probably the biggest one on here that I think should be literally the only one on the screen. We keep letting these big companies that come in that actually have the money that can be like, I'll pay cash, because they're using our money that we invest into their banks and put into their banks, and so they can do this stuff. They've got money for days. But I think there are places like each neighborhood, especially in like the townhomes or condos and stuff, where they only allow so many properties to be like rental properties. So I think that's a good thing. But
I agree.
I don't. If all these big companies just come in and start buying up houses and whatnot, they're just going to spike up the prices, and they're just going to make everything more unaffordable for the rest of us who don't have an endless pocket full of money to play with. So,
Well, I mean, hello, y'all said anyone that understands policy understands that you can't treat a problem without treating the cause. Ergo, you're fixing the symptoms and not the cause. And the cause isn't always the problem. Well, I would say the root of the problem is that manipulation, in my opinion, right? Yeah. So if we keep just manipulating, you just keep these asset prices up. I can go into a whole diatribe of how all the rich people lend or borrow against their stocks, so that they never have to pay taxes, and it just goes down the whole rabbit hole. But that's all part of the problem,
right?
So the final takeaway. Here's the thing: me and Brandon are not trying to belabor the point. We don't agree that a 50-year mortgage is going to fix anything. I don't think so. But everything is used as a tool. Like, you have your own situation. You're not in my situation. You're not in Brandon's situation.
We don't know your life.
And that's what, huh?
We don't know your life.
Yeah, you could be in a totally different situation. That's why we talk to people like Lucy, who can actually address your situation, give you an idea whether it's a good or bad idea by talking about your timelines and all this kind of stuff. And the good thing is we have Lucy coming up here, so she can talk about it for herself. So we got Lucy Thornton, Lucy the lender, from Edge Home Finance here with us. So I'm super excited to have her on here. Hey, Lucy, how you doing?
Hey, friends. I'm good. How are y'all?
Good. I was going to come to your little open house thing that you were doing, but I had an open house.
Well, that's okay. That's
just as good
as excuse as it gets then. So that was good. It was good information though. So
Lucy, let me ask you a question real quick. What did you think about what we had to say? Is there anything stupid that we said?
No, I mean, it's all valid, right? I mean, I think that, like you said, I mean, sometimes it's what works for other people. I think we, as professionals here in the Savannah market, are just speaking about Savannah, right? So I personally also agree with here, it doesn't make a lot of sense to save $100 or $200 to put it out of the life. But we've had this as a team discussion, and people that are in Hawaii, I can tell you that 50-year may make a bigger difference, right? So if you're in high cost areas, this could, right? I mean, I do have some people, sometimes I am just, and so we talk, y'all hear this saying a lot, debt to income ratio. So this can move the needle, right? Let's say someone is in a loan right now, they can't get out of it. They can't refinance it. They can't get away from it, and so that $100 or $200 may at that time, again, situational for everybody. So just knowing that overall picture, I think that that's kind of what they were seeing, is this may have been meant more for those in a higher cost area. I still think it does not cure an affordability issue. To me, it also almost creates a little bit more of a beast of, we want this crazy equity gain, right? You love that as a realtor. When you go sit down with a Mr. Seller, you're like, Mr. Seller, you got $200,000 worth of equity. What are we going to do here? So we've gotten very used to these, very strong, equity gain markets. Well, that's not normal either, and it's not healthy. And so we've almost created that problem for ourselves. I mean, COVID did not help any of that, right? So
the spike in prices in a 2-year period was just crazy.
Yeah. And so it put out a lot of people that I think, again, we don't have as much of what we think of, high cost area. I mean, do we love the 250s around here? Not necessarily, right? So some of us just have some champagne taste that we just got to get over, right? So
with that McDonald's budget.
Yeah, exactly. So and I know we had a comment a little bit ago. If I were to think of other solutions, right? When I think of, our overall interest, when you have a person that now you can't buy a car. I mean, I personally don't buy $100,000 car, no judgment on anybody else, but $100,000 car that you have 7 years to pay it off. These payments are through the roof. I have what I call financially responsible people that are paying $1,200, $1,300 in car payments. Insanity. I had one the other day. It was a couple that had 2 car payments, is $2,800. So to me, I think that we have bigger problems, in other areas. Oh, friend.
Oh
yeah.
my God.
Yeah. $2,800 in car payments, I hope you can live in it, you know? So, yeah, so
They got the Yukon SUV extended version.
seriously, you know? So I think that too, I mean, so that cost of money, that bucket of money is pushing our bucket of money in housing, right? And housing is a primary, you know, there's no living without housing, you know, and you feel sad for, you know, your situation, but also your children's. Like, how will our kids be able to afford homes?
That's the only thing I keep thinking about.
Yeah. So, so I think there's some benefits there, and I think that's really what the goal was. Now, I think we have some pots of money sitting other places, probably got spent somehow, but like, okay, for example, like the FHA requires upfront mortgage insurance. I mean, we have a pot of money that is something like 540. I mean, it's an insane amount of how much over, like, even if every FHA person in the country defaulted, it would still, you know, we would still have money left in it. So like, there's
Really?
things that to me, like, yeah, I mean, that I think that we could do to help, you know. Again, is there a grant program, you know, and what's those stipulations and what's that gray area and stuff, you know? But I mean, again, let's just lower some interest rates. I don't know where the government, I mean, I don't love government control to step in and do that. And that's really what's here. Like someone else mentioned that about politicians. This is politicians just trying to be like, oh, I helped fix it. No, you didn't. You know, there's no fix, you know, especially where we are, right? $140, $220, $320 doesn't make that big of a needle mover, right? You know, so where if we could get some lower interest rates, not at 6.5% and 7%, you know, I think that would move the needle more and help affordability. So, and
I'm going to come back to that because I agree with what you're saying to a certain extent, but this is where the manipulation comes in, and I want to talk about that later. So, okay. Brandon, you start us out with the question. I know I asked the first question. I just wanted to capture it, but Brandon starting out with the actual.
And sorry, I just went off too on a bunch of that.
No, you're all good. That's all good.
Yeah. Don't apologize. We love your education.
We love it. Thank you. You're helping us out.
Can you explain exactly how a 50-year mortgage works and how it differs from the 30 or the 40-year loan?
Yeah, I mean, it's just that. It just extends it. So it takes it from, you know, 180 months, 15-year, 360 months, 30-year, to a 600 month. So 600 long months. So, you know, an amortization schedule is really ugly. I'm sure you guys have looked at one before. Most people haven't, right? Till they sit down to sign and they're like, wait a second. On my $3,000 a month payment, $108 is going to my principal, you know? And so, so that number... Yeah,
on the 50, it was $68.
Yeah, it's insanity. So on that, it's even uglier. So yeah, but it just extends the time, just takes it out.
Oh my God.
No, I think I appreciate you. And let me ask you this: so we're talking about debt to income ratio is 50 years. Like, I mean, is that where you're seeing the true benefit? Is the debt to income ratio? Like, yeah.
That to me, again, it's because I'm licensed in some high cost areas. That would be the only one that would hit my desk in any of these scenarios. There's sometimes that I need literally $50 for people. And we're calling insurance, right, you know, and something like that. So it could be a short-term Band-Aid for some people. So some people that are just really outstretched, or like I said, they can't get rid of a payment for now. I mean, like I had a lady the other day, she was carrying a payment for her daughter and carrying a payment for her son. So essentially it wasn't really even her debt, but there's nothing we could do. You know, it's not, they couldn't take that. And she's like, well, they pay it. Well, great. Doesn't matter. It's on your credit, you know? Right. So
unless she's leasing it to him, right? But that's a whole other thing. So you would say it'd be ideal for people who are trying to fit into a DTI situation.
Yeah, absolutely.
So wait, should I be making a phone call? You know what I'm saying?
Yeah, maybe we should. Yeah, I think that was some others. Credit kills people too. Golly, credit.
So are lenders actually offering the 50-year product yet, or is it still
I have not seen that roll out. Nope.
No. Well, that's good.
Not anybody in my portfolio. No.
And you'd be like, no, hard pass, don't do it.
Yeah, I mean, I don't have to do it at all, you know. So it's like, again, I think it'd just be very situational, which hopefully they choose a lender that can just talk them through those numbers and educate them, you know, and not just put them in it. So. Yeah, we'll have 30-year car payments here before long. Just wait.
Unbelievable. Okay, so let me just ask you this question. How might appraisers and underwriters view a 50-year mortgage compared to traditional products?
I couldn't see where, again, an appraiser is not going to have anything. They're not going to give a rat's, right? I mean, so underwriters, yes, right? Because again, that separation of we're looking at a house and we're looking at, I mean, I guess if an appraiser is doing something as far as maybe like a rent analysis. So if you have an investor, maybe those numbers would come into play. Probably not though, right? Now I'm going to rewind and say, okay, here's to me another positive. If you have someone that really wants to cash flow a property and that $200 would help them in that cash flowing that property. So that's where it may come into play for an appraiser, is if they're looking at that from that standpoint. They have an ADU that they need to calculate some more income in there. Like, okay, well, that could possibly. Same thing with an underwriter. It's just a debt to income ratio.
Okay.
Brandon's face. I love you, Brandon.
It's just, oh my gosh. I hate it.
It's just, yeah. It's just the government trying to right itself, and right now they don't know how to right themselves.
And it's super frustrating.
Pretty simple.
This is people in their everyday lives, and how can we make their lives worse?
Yeah.
Thank you. I'm glad we voted you in. You're welcome. Thank you so much. Is there like a long-term downside for stretching out the loan that far outside of just paying like more interest, would you say?
So same, like you just have literally no equity. I mean, you've lived in it 3 years and you've paid, $395 on it. So you're then upside down on that. So your only play is to have equity gain, like natural, I mean, and we know in a good market, you really want 4-5% equity gain, 3 to 6. Let's shoot the gap and say 4, right? That's healthy. Yeah. And so that would still take you quite a bit, a long time, and you would have no touch. Yeah.
We did the math. It was 4% was the natural.
Yeah, 4%. I mean, I've been in this business 20 years. Is the most healthy of markets, right? 20% that we've had before, not healthy. I mean, does an investor love a 50% equity gain in 2 years? Hell yeah. But so yeah, you would have someone that essentially would have gone nowhere on their principal payment. Even after 10 years, their principal payment would still look like hell, so that would be definitely a big negative. Okay. So let's talk about this and higher interest rate. So if you want a 15-year or a 30-year, guess who gets a better interest rate? 15-year. So what are we going to do? We're going to keep going on that scale. So that's where it's also not necessarily beneficial. So then it can be offset, this interest rate can offset this gain that we're hoping to capture over here. But again, how has it been sold? How's the narrative been sold, right? So it's like all over the internet today, and this is not the right thing, is Fannie and Freddie don't have the credit score limit anymore. This is the biggest crock of crap too, right? It's what's narratives being put out there, right? Like credit matters, number one factor, so.
Wait a minute.
They erased it all together?
I don't know. I haven't done enough research, but I've listened to, I hate to say no one else has watched it either or done their research, and I've seen it pop up on my feed all day long with.
I've heard about it. I thought where I saw, and I don't want to get political here, so don't take me wrong.
Same.
I guess Trump printed or did a on True Social. He said no more no more credit scores or something like that, and I guess that kind of started this whole cycle. Now, obviously, we had talked about this. Kind of leads me to the question. with VA loans, there's really no credit score, right?
And that one's given, right? So Freddie and Fannie are a conventional loan. Freddie and Fannie conventional loan was 620. You couldn't get a conventional loan for anything under 620. Here's the thing. You don't want to get anything under 620. You don't want to get anything under a 680, or your pricing and your rates are so horrible. Your mortgage insurance is through the roof. So now we're going to give a 580. Your interest rate would be a 10% and you're $400 a month in mortgage insurance. Like, Doesn't exist either. Again, people are just trying to tell some people out there. I mean, I know everybody's trying to get the phone to ring right now, right? But again, it was really dumb dialect out there today. I was like, oh my God, please quit putting that out there.
Right.
Please stop, for the love.
I feel like that was a lot of the videos I saw today too, was talking about that.
Yep.
That just, oh my God.
You kind of confirm the assumption that we made on the slides, right? So there would be a difference between the 30 and the 50, right?
Oh yeah. I mean, monthly. Interest rate wise, yes. Now, because there's no way for me to quote unquote price it right now. I mean, I don't know if it's a 0.5% interest rate or if it's, because like from a 15 to a 30 is a 0.5%.
Well, that's what we factored in, a 0.5%. Mm-hmm. That was that when we did our assumptions, that was the assumption we made.
But again, 0.5%, you've just negated everything. Like yeah.
This is where the math got funky online, right? They would say, "Oh, you're saving $220 a month," but when I did the assumption and added that 0.5% interest rate change, it only took it down to $111 per month. So I think that's a lot of part of the thing where it's like, okay, these people are saying these things. They're putting out these. I'm not trying to say there's people out there that are trying to be disingenuous. Some people just don't understand the difference.
Right.
Like they don't understand
it sounds really good. People hear what they want to hear. They want to hear that they've just heard a solution.
What?
So what?
Is that crazy. Selective hearing? I don't know.
Can't even imagine that. So yeah. Of course.
So,
all right, Brandon, what's your next question?
Like with the average person like staying in a house for 7 to 8 years, what are your thoughts on the adjustable rate loans, like the 7-year ARM versus the long-term fixed loan?
Absolutely. I mean, to me, that's more favorable, right? Now, you still have some risk level, right? I mean, every there's going to be a risk, but if you can save 1% on that, and just knowing, in 3, 5, 7 years, it's going to adjust, right? And you have a floor seat, you have a floor, you have a ceiling, that's the thing about adjustables. And I think that adjustables got such a negative rap, obviously, 23 or, however many years ago. So it's like, so that part is, scary-ish, but honestly, I'm not gonna get a person that has a great financial, overall picture that's gonna call me and say I want a 50. They're gonna say, Lucy, I want that 5. I want that 5-1 that's 5%. Give me that. And I'm gonna say, okay, so yeah, those will become, I think those in this narrative will actually become more popular. Yeah. I mean, think about it. Our neighbors, our neighbor to the north, all 5-year mortgages. All of our neighbors across the pond, 5-year mortgages.
Oh, sorry.
Right, but I mean, as you know, and they in Canada specifically, is their houses are in the millions right now. So I mean, like this for people that are, I had my 5-year loan and now I don't have it anymore. I can't even afford to be in the house that I'm living in. That's not a great solution either.
Not a great solution either.
But I understand.
But we're the only country in the world that has 30-year mortgages.
Right.
So. And I think, if we could just make sure I think that's what I'm saying. Try to just preserve that in some kind of way. And this is kind of just one of those things where I say, kind of just let the markets correct themselves. But I don't want to keep pounding on that. The one thing I want to say is, and this is going on the ARM thing as well. So if someone is choosing between a 7-year ARM, 30-year fixed, or potentially a 50-year, what factors should guide that decision?
Rate sensitivity, right? So where do you need to be monthly, right? So a lot of times someone will call me and say, we want to get pre-approved for 450. Great. What does 450 mean to you? Right? Where does that, what does it mean for you monthly? So I always want to work backwards on a note, right? Or on a purchase price. And so where do you want to be monthly? What is your long-term goal? What does it look like? What does your next, 7 years look like if we're going to put it out over that, so obviously, we all knew a lot of military. So are you moving in 3 years? I wouldn't let you pick up a 50-year mortgage, in that amount of time. And so, in the 7-year, are you shifting around some money? Are you, how much do you have down? Yeah. I mean, it's an overall financial health picture and just questions. Right. And for most people, if you call me and you're just like, every dollar counts, then we have to then go for that ladder, right? We got to go for that 30 or 50. But somebody who doesn't want to give away any more money to anybody, we're going to go to the, adjustables that are, they can move it around to make it happen.
I think that's the first question I always ask is, what are you comfortable paying monthly? I don't care about anything else right now.
It's the most important question.
What can you handle monthly that you're not house poor?
Mm-hmm.
That's huge.
Yeah. And don't shop for the house first. Shop for your budget first. So, yeah.
Know your role. Or in this case, budget. So is there a way that the borrowers can calculate the real cost of each of the options to make the most informed decision?
They would have to probably get some mortgage calculators, but I'm sure there's some kind of online tools. I'm sure you guys have recommended some as well that you could use. And so, for
Lucy, call Lucy. That's the recommendation.
Lucy. Yeah, 580-284-7244. Yeah. Obviously I just use my own systems, but for any ARM, it's typically at least, again, 0.5% to 1% less. So they could easily calculate that in there.
All right, I'm going to ask you a question that's not on our questions, and I didn't send this, but I want to know. Okay, so when you talk about the government reducing interest rates, we know what that means. They're going to have to do mortgage-backed securities, which causes inflation. So, do you think that's a real solution, or do you think they should just allow the market to do what it's supposed to do?
Okay, so personally, I think it's fake money, right? Like, I think it's a fake adjustment of saying, what are you truly, really buying? So yeah, it's inflation ultimately, right? So, but I think there's got to be an economist out there that could give something better, and or,
just write it out.
Yeah, that's really, historically, that's how that money has been bought and sold, and that's now how that system is set up. That's why we have a 30-year mortgage, so at what point we take that away and we maybe give it back to a bank or you talked about Blackstone, or you just have they have a big bucket of money that they're like, okay, this pot is here at 4% until it's gone, and so or investors, if I could have some private wealth money over here, I wish, from my trust, you can borrow at 4%. So, but ultimately money is still cheap. I know that sounds not like what we want to hear, right? But historically, if we look at it, that percentage is still cheap. It's just the cost of living is significantly higher, and so it's become, we go back to, you have to be a 2-income family to purchase a home. You've got to be making you got to have 3 0, we got to have 6 figures here. And so, it's sad, and it's not what everybody wants to hear. And, we're going to be in multi-generational houses. Everybody get your ADUs out. I don't know. Yeah. Brandon, get your mom ready. Come on over, mom, not that any of those are good solutions. That's not what you want to hear. But you see it as an issue. And again, unless we create some other kind of system where, there's a bucket of money that can be bought and sold for less, that can't be off the same system we've been working with this whole time, so then you have to go privatize money, right? So
well, what if we just don't move? What if we just leave the interest rates where they are and let the market do it itself? Is that not a solution?
That is the solution.
It's common sense, though.
We're not going to have 4%. We're not going to have 3% interest rates anymore, right? That crashed the market. That's also not healthy, right? So, I would personally, just as being in this industry so long, I don't want to have that equity gain, as abrupt as it has been before. That part, I think, is more detrimental than anything else. And again, you can't stop that. Demand is demand, and so
right.
Once it's there, everybody keeps talking about these 30-year-olds that are all in their mom's basement, and there's going to be a ton of demand, but what does that look like? I'm not quite sure. And so
they're getting annoyed, and they're saying, how can I build their credit score up so you can get them out of my house?
Well, I can teach credit all day. So
that's a text I got the other night. It's driving me crazy. How do I get him out of my house?
Yeah. Tell him to go get three jobs and save money.
Let me catch up on these comments real quick. So my dad, thank you for watching, Dad. I really appreciate it. When we get down to zero interest, it will be a good option. Dad, I don't agree.
he means for the Fed rate, or does he mean for does he think that interest rates would be down to zero?
Dad, let me know. Are we doing
Yeah.
ZERP again? Is that what we're trying to do?
Is it the Fed rate? Because I mean, I think also if the Fed
Fed
rate, because the Fed rate overall, again, is everybody's money that's so expensive, right? It's the cars that are so expensive. It's the
Oh my God,
everything.
yeah.
Yeah, I mean, it's the credit cards. It's the people, so that would absolutely help, So, and that in turn, I always tell people, obviously, mortgage rates and Fed rates do not go like this, but there is correlation, and
they're
so
moving up together.
Yes. Yeah.
sometimes the last 3 times that is, the last 4 times that's not been the case, but
because they're not buying, the investors are not buying the 10-year yield. I mean, they're not buying it.
Fake money. I mean, can you blame them?
Fake money.
So.
Hello, y'all said it's a faked adjustment. That's a fact, and or it can't be manipulated. I agree with you. I don't want the manipulation. I think that if it could just be for a little bit, like it doesn't have to be forever, right? You know what I'm saying? Like,
Right.
Let's just get the housing prices back to where they should be. I'm going to show you guys something real quick, and you don't mind, Lucy. Hold on one second.
You don't
Show
mind.
you. Look at this is the housing market prices, and look at this time period right here.
I was going to make a sound thing from you. A sound
How
loop
fast
of your,
it went.
Woo!
Yeah, like unhealthy. That's unhealthy growth, and that crushed us. Right now, I don't.
This is what we're against right now.
I mean, we do not want a downturn, but I mean, because that obviously is also detrimental, and so and we're not going to get a 2008 again. Too much demand there, and so too many 30-year-olds that need to get out of a basement, and so but so don't pray for a market crash. Whoever prays for a market crash, I'm gonna send them my mortgage. So yeah, but
Hello, y'all said she was agreeing with your guest, by the way.
I'm going to send them my mortgage.
Yeah.
Jesus Christ.
But I want to say thank you, everybody, for watching and commenting. I really, really appreciate it. And thank you, Lucy, for coming on and clarifying some of this stuff for us. I know we can't solve the problems here, obviously, but we like to talk about them so we can educate people so they understand. Is there anything we're missing on this 50-year loan thing that we didn't talk about that you want to talk about?
No, I mean, it's just our government putting some buzz out there for us to have something to talk about. Thank goodness, right? We needed we needed to see each other tonight. The next week is portable mortgages. So then we'll call that one out next week.
Oh, let me ask you this. Portable, what do you mean? Is that a real thing? Are people really talking about that?
Listen, that's the next big blast over the headline. So essentially a portable is an assumption, right? I mean, they're going to, but it's just your money.
But you can already do that. You can already assume if
you can assume, right? But this is like, so again, not have done,
Yes, right.
I got no extra hours in my day to be researching junk headlines, right? So, but the portable mortgages, the concept is like, okay, I would take this $200,000 mortgage at 2%, and I take it over to the 450 I want to buy, and I take my equity with me, right? Versus, okay, now I'm taking just the equity with me, but I'm going to get advantage of this 200 that I have at just 2% or 3%, all the good, numbers we used to have. And so that's what a portable mortgage is basically moving your mortgage over at the same amount. Again, what lender in their right mind, who's going to process this, by the way? And you're going to get this for free? You're going to have what mortgage originator, what processor, what underwriter, what company in God's green earth is going to be? That's a great idea. Let's do this. That's
exactly what we were saying. Like, there's no lender in their right mind. They don't want to lend. So, and this is why the example I gave, not only to Brandon, but to my dad too. I said, what bank would want to take a 2.75% interest rate from me? They're losing money every year on that loan.
And again, like, it's to cover the spread too. Like, you have to come up with so much cash, which that's why nobody can do assumables either. Like veterans don't have, not just veterans, right? But like, just to do an assumable, you have to come up with so much cash flow. Well, I mean, who has the liquidity and or like that still makes the best amount of sense. So, I mean, yeah.
You can keep your rate.
You can keep your rate.
That's crazy. That'd be awesome if that's the case. Well, once again, thank you again,
Mhm.
Lucy, so much for
You're
coming. I really appreciate it. And
Love you guys.
thank you all for watching and commenting. I really appreciate it. And Brandon, of course, it's a pleasure always. And I'll see you guys next week.
Bye, friends.
Silence. Mwah.